over 20 years. And first with the town of Pelham for 5 years, and then the village of Scarsdale for 20 years. I retired in 2019, and I'm doing part-time work on the other side. I'm an Appraisal Institute designated SRA appraiser, so I've got a 40-year, believe it or not, or 41-year background in assessment and appraisal of the valuation of real estate in the 5 counties. I'm also a New York State certified general licensed real estate appraiser, and I hold a New York State licensed salesperson's license. So what is an assessment? I followed Tony's outline, which he set up, was kind enough to set up so that I could answer some basic questions. What is an assessment? And I started by the basics again. Real estate taxes pay for all government functions and services. And so how do we collect taxes? How do individuals, how are they assessed? And that assessment is the basis for the individual taxes. Assessments are all ad valorem in the country, that is at or according to value. And the original assessment on all properties, wherever you are, New York State, Florida, California, Hawaii, they're set by a computerized mass appraisal system. So some municipalities such as Mount Vernon goes back to the late 1800s. Scarsdale did a revaluation in 2014 when we started with this computerized mass appraisal system. And that's really an algorithm, a bunch of mathematical formulas that predict the values of properties based on the recent sales of similar properties. And then once the computer sets those assessments going forward, the assessor maintains all of those values thereafter. But in the instance with the majority of properties in Westchester County, at least in particular, when an assessment is not maintained at 100% of value, the New York State Office of Real Property Tax Services issues what is called an equalization rate. And that is supposed to equalize that number that's fixed already on the assessment roll. And for residential properties, that equalization rate is known as a residential assessment ratio, or abbreviated RAR. And that's calculated based on the sales that occurred during the defined 12-month prior period. And it should vary or often varies every year. There's a reversed relationship between assessments and values. That is, when an RAR drops, that indicates a higher fair market value of that assessment. So what is a tax grievance? It's really an assessment grievance. You're not really grieving taxes, you're grieving the value on which taxes are based. So that's just to help you get a basic understanding. You can file a grievance once a year in all towns and cities in Westchester County. That filing deadline is always the fourth Tuesday in June. It's the third Tuesday in Rockland, Putnam, Dutchess, and Orange counties, New York. So be careful about that. The filing deadlines vary, and there's a strict adherence to those filing deadlines. There's a basic assumption under the real property tax law that all assessments are deemed to be accurate. That is, you have to prove as the property owner that the assessment is not accurate. So the burden of proof is always on the property owner, and the property owner has to submit what is called prima facie evidence of value. And you can do that via an appraisal, comparable sales, a CMA, or you can show there's been some error in the inventory that the assessor has of record. A lot of the mathematicians in the county are those people that try to show that an assessment is inaccurate by doing per square foot cost analyses. That's not really a valid approach to challenging an assessment. How does filing a grievance affect property taxes? Generally, a successful grievance reduces property taxes. And the only reason why I say generally is there'll be times where a municipality has to increase their tax rate significantly from one year to the next, that a small reduction in assessment may be offset by a tax rate increase. But generally, overall, if you reduce an assessment on a property, you're going to have reduced taxes. And the formula for determining taxes is an assessment times the tax rate equals taxes. And so it follows a reduced assessment times the tax rate equals reduced taxes. So what is the tax rate? And again, I'm sorry, I'm just not going to assume that everybody has the basic understanding of a lot of these terms. So a tax rate is the revenue that a municipality needs to pay their bills divided by the aggregate town assessed value. That is the aggregate value, assessed value of all properties in that town. And you come up with this rate, this factor, and that's applied evenly to all properties. So properties with different assessments will have different taxes. And I write here, unless there's the homestead law into effect, and that's really somewhat of a complex concept to get into here because it could take a while. But there is a law on the books that allows municipalities to tax different classes of properties at a different rate. They do that in the town of Pelham. Commercial properties pay or can pay, often pay a higher tax rate than residential properties. And there's a whole theory behind the validity of that and why a municipality would do that. But maybe we shouldn't get into that here today. The next question was, how do I qualify for a grievance? And how often can you file? All you have to do is own the property. Anybody who owns a property and you're considered to be aggrieved by a tax can file a grievance. There's no occupancy requirement. And there are several bases on which you can make a valid claim. One is to provide evidence of an excessive assessment. And I indicated before that would be via an appraisal or a CMA or putting some comps on a piece of paper and showing how your assessment is too high. An illegal assessment would be, you'd be surprised, but there are times when a property is not located in your municipality or a certain portion of it is not located in your municipality, that would be considered an illegal assessment. The wrongful denial of an exemption. Assessors are charged with the authority of approving exemptions, the STAR exemption, the veterans exemption, the senior exemption. And if under that authority, the assessor feels that the exemption should be denied, you would file a grievance against that denial to the Board of Assessment Review. And the Board of Assessment Review would hear your argument. Sometimes properties are misclassified and assessed erroneously. A property may really be a 2-family house and it's assessed as a 4-family house. That's just one example. By law, every year, you can file a grievance to challenge your assessment. But there's a but to that. If you appeal that determination of the Board of Review and you go in front of a judicial hearing officer, that assessment reduction is frozen for 1 year in a small claims proceeding. In a Supreme Court proceeding, and you receive a reduction by a judge, in other words, a judge signs off on that stipulation of settlement, that assessment is frozen by both parties for 3 years. That means the assessor can't raise your assessment and you can't challenge your assessment for 3 years. There are some exceptions to that. I want to make sure people understand that. If there's a revaluation, if there's a change in zoning, or if you take out a building permit to make new improvements. So there are exceptions. I just wanted to point that out. So what is the process of filing a grievance? It's not difficult, but there's a strict adherence to filing deadlines. There's a specified form that's recommended that you use. It's RP 524, and you have to complete that document to the best of your ability. Any errors or any blanks that are left on the form do not serve to dismiss the or make it ineligible. You would fill it out the best you can, but most importantly, you have to file it before the filing deadline. And again, check those deadline dates with the assessor's office, or they have that information online, or the Office of Real Property Tax Services, which is the New York State Oversight Agency that oversees the assessment function for all municipalities in the state. They have that information online as well. And along with filling out that form, you have to include your evidence of evaluation. You wouldn't just fill out the form, file it and hope for the best. You would want to make a valid claim. And as I indicated before, you would provide an appraisal, or you would submit a CMA or some comps. You have the discretion to determine what constitutes your evidence, but the best evidence, quite frankly, is an appraisal. Boards of assessment review typically rely on an independent third-party appraisal to help them make their decision as to the claim. So there's this Board of Assessment Review, and that is comprised of your residents, your neighbors in a given municipality. It can be a 3-member board or a 5-member board, and they're appointed by the town councils or the city councils. And they sit once a year and they review each and every grievance. The bigger municipalities, I can't envision how it might work, but I know in the smaller municipalities or the relatively small municipalities, the boards of review do a good job. They do review each and every application. They're not going to spend a lot of time on each and every application, but they will, particularly if it's an appraisal, they'll cut right to the chase. They'll get to that grid page and they'll see if, you've submitted some good evidence. They'll meet over the summertime generally, depending on the filing period, and they'll make determinations on each one of them. Before September 15th, they'll turn over their list of changes to the assessor, and the assessor is responsible for making those changes on the assessment roll. After that, the assessor then files what they call the final assessment roll, and by law, that's supposed to be done no later than September 15th. For cities like New Rochelle, have a different filing deadline. That's August 1st. Rockland, Westchester, Rockland, Dutchess, Putnam, and Orange counties have different filing deadlines as well. I use the September 15th because that's there are more towns in Westchester County than there are cities. But villages also, some villages have assessment rolls and they have different filing deadlines as well. So after that final assessment roll is issued on September 15th, the Board of Assessment Review will issue what they call notices of determination, and it will set forth the assessment before you challenged it and their determination or the assessment after you challenged it. And they'll do that. They have 10 days to get those letters out to property owners. So if you file a grievance and the board rejects your claim, that happens a lot. That happens more often than not. You have the right to appeal their determination. So in theory, you have two opportunities to challenge an assessment. You put your grievance in front of the Board of Assessment Review, and if you don't like their determination, you can appeal that. So I call that the second grievance or appeal opportunity, and you have two options as to which court you wish to put that in front of. Most residential property owners put that in front of a small claims assessment review hearing officer. It's called, an acronym is SCAR. That's a inexpensive and expeditious way to resolve the claim. There's only a $30.90 filing fee, but you are limited to an assessment reduction of 25% when you use the small claims court. Your property also has to have not only be owned by the property, it has to be owner occupied. So particularly in the case of 1 to 3 unit dwellings, you say, well, the owner has to live in one of them. That makes that property eligible for SCAR. You don't need an attorney and you don't need a representative. But I will just say that it's probably, as we go forward with this in this very strong kind of a market, that you may wish to hire an attorney or a representative. I'll get into that a little more later. The second avenue of challenge that you could take is the Supreme Court tax certiorari part. There's no reduction in the assessment amount that you can obtain there. And all property types are eligible: single family, commercial, industrial, multi-story apartment buildings. That's the court that handles any and all assessment reduction claims. There's no owner occupancy requirement, but you do have to have an attorney because those documents have to be filed in the Supreme Court. The downside of using the tax certiorari part is the filing fees are greater than if you were to file it in a small claims part. And the resolution of those matters takes years. And I mean years. There were some that took 10 years, there were some that took 2 years. But for residential property owners, which I think perhaps the majority of the people on the call here today represent residential property owners, you would or your property owner would be wise to use the SCAR process as opposed to the certiorari part. Can a tax grievance benefit your seller? Absolutely. Yes, there's a direct relationship between taxes and property value. The lower the taxes, the higher the price you might be able to sell that property for. So if there's an unfair assessment on that property, those taxes are greater than they should be. That's going to impact on the buying power of your prospective purchaser. And it's going to also, when the homeowner initiates or the seller initiates that grievance process, it removes the uncertainty of taxes. And I'll just give you a quick example. I represented a property owner, and I'll get into that later, in Harrison. And the assessment was about $1 million greater than it should have been. based on what they were asking for the property, based how long the property had been marketed. It had been on the market for several months. They kept reducing the price, yet the buyers were still uncertain about this. There was no guarantee that they could take that list price or that eventual, if they had purchased it, that eventual purchase price to the assessor and gotten it reduction. So if the seller initiates that, it removes that certainty that the process has been started and that somebody else will take charge of following through with that procedure. So one last part of that, I think, is it impacts on the subsequent buyer renovations. Not all the time. Many houses are, brand new houses are sold in tip-top condition. Nobody needs to do any renovations there, but many of the properties that you list and sell require renovations after the sale. And if the property is not fairly assessed at the time of sale, and the timing is such that you've missed the window of time to file that grievance, it's going to impact on the amount of the dollar amount of renovations that a purchaser or a buyer can make going forward, because again, that tax scenario is unsettled. And there's a whole mathematical calculation that the assessor goes through in order to determine how much of an assessment increase is relevant when a buyer does renovations. So there are benefits of hiring an experienced tax grievance consultant. I will say, I'm in this business now. I've been on both sides of the table, so I have a little bit of an edge of understanding the process. I don't think it's no longer what most people saw as an easy process. Before, you could go in, file a grievance, attach a few comps or even an appraisal, and the assessors were so overwhelmed. They had no staff, they didn't have any resources, they were forced to settle those claims. I don't think that's the case anymore. They have far better in-house resources. There's computer programs that they've been able to attain, and they now have staff. The majority of them have staff, not all of them, but the majority of them do. And most importantly, I think what's impacting on the process is that we're in a really strong market, as you know. So that emboldens assessors, that gives them, the backing that they need to in the negotiation process, and that gives you less of a chance of success in reducing the assessment. So, and I think that's where an experienced tax grievance consultant comes in. The market, you can speak to the other properties that sold. You can talk about the greater market and economic forces that go into real estate values. And so the other benefit is that the average homeowner, not everybody, but the average homeowner finds the process and procedures convoluted. And quite frankly, it is convoluted. The statutory deadlines, the strict adherence, and there are little nuances to the system that you wouldn't understand. And again, just by example, maybe I can help you understand it. I represented a property owner in Rockland County, and he had a big, beautiful new construction house that had an in-law apartment in the basement, which was legal. He took out a building permit for that. He had his nephew living there. And we filed a grievance on it. And the the deputy assessor insisted that it was a 6,000 square foot house. And I said, no, it's about a 3,600 square foot house with a finished basement. Yes, it does have a kitchenette. It has a full bathroom, but it also has the utility room. It has access to the lower level of the property. Part of that unit was below grade. The back of the building was below grade. That's not considered living area. So having known the data collection, the New York State data collection manual and the rules and procedures, I was able to, go back and forth with him. I was able to push him back and say, you can't look at it this way. You can't value it this way. It's not a 6,000 square foot house. It's a 3,600 square foot house with a finished basement. And not all experienced tax reps would know that. And, that's just maybe a little advantage that I have. So why would you hire an experienced tax grievance consultant? I like to use the analogy. If you find yourself being audited by the IRS, wouldn't you hire an experienced IRS attorney or representative to represent you in an audit? I know I would. To me, those are the people most qualified. They know both sides of the equation. They can get you through that audit better than anybody else. There's a thought process out there that attorneys are more qualified to represent property owners. And nothing against attorneys. My father's an attorney, my brother's an attorney. I work with attorneys. It's got nothing to do with attorneys per se, but there is that misperception, I believe, that attorneys are more qualified to represent property owners, and that's not necessarily the case. They have to know the area. They're going to go out and get an appraisal just as a tax grievance representative would, but their ability to negotiate and to talk the talk is different than an experienced tax rep. And lastly, a tax grievance consultant assumes full responsibility for the entire process. You don't have to worry about the adherence to deadlines. You don't have to worry about what's required to be filed. And to a lot of people, that's valuable. People are busy these days, and to have somebody take over the process is worth something. The question is, what are the fees involved with filing a tax grievance? If you represent yourself, there's no fee. You're going to need some evidence I had talked about. So you might want to consider getting an appraisal. And appraisers will charge a fee that ranges depending on the complexity of the property and also how busy they are. It's supply demand dependent. Appraisers are very busy at busier, I should say, at different times of the year than others. And so I think their fee will reflect that. They'll do bank work for $350, $400, but I don't know that they'll do tax work for that same fee. I'm an appraiser also. I'm not doing appraisal work for tax grievances or for mortgage appraisals, but I know the fees do differ. And I also know, like everything else today, the fees have gone up. So that might be your only expense if you were to file a tax grievance and you did so representing yourself. If you represent yourself on an appeal, there's that $30.90 filing fee. They added that 90-cent filing fee for credit card charges because you have to file electronically now. And then most representatives, if you represent yourself, if you self-represent yourself on an appeal, they have 45 to 75% of the tax savings. If you represent it in an appeal in a tax cert matter, there's a $300 filing fee. But an attorney is also going to take 33 to 50% of the tax savings. And the reason why those fees are a little lower on the tax cert filing part is because it generally takes more than 1 year to complete or to bring the matter to resolution. So like I say, oftentimes I saw 4 to 6 years it took to file or to complete a grievance. And each year, if there was a reduction in each year, that attorney got 33 to 50% of each year's tax savings. So it adds up and it can be a big number the longer that process takes. I put in here some of the formulas I thought brokers should keep handy, and this document will be available for people. It can be sent out after this, but I think all brokers should really get used to calculating some of these numbers because it's really basic mathematics. And once you catch on, once that process sinks in, it'll come easy to you. So how do you calculate taxes? And the formula for that is an assessment times the tax rate equals the taxes. And just as by way of an example, I said, if the assessment was $1 million and the tax rate was $25 per thousand of assessed value, the math would be $1 million times 0.025. And taxes would be $25,000. If you had an assessment and you wanted to know what the fair market value of that assessment is, you would take the assessment divided by the RAR. That's the residential assessment ratio. And by example, that's the $1 million at the RAR, assuming the RAR is 100%. The assessment is equivalent to $1 million. And lastly, how to calculate an assessment. If you have a sale price on a property, you know that a property is going to sell for $2 million. And you would go and find what the current residential assessment ratio is in that community. I just use this one as an example, 87.55%. The assessment is the sale price times the RAR, that 8.8755, you got to divide it by 1,000. And you get the assessment of the property. So even though it sells for $2 million, it's going to carry an assessment of $1,751,000. I referenced this before. This is just an example of a property owner that I represented. He was a famous New York Yankee. He was known as the Sandman. I don't know if anybody knows that person is by reference. I saved him over $1 million, almost $23,345 in taxes. You say to yourself, how does that happen? The property, he purchased the property for close to $5 million back in 2005. And because they didn't keep challenging the assessment, or they weren't on top of the assessed value relative to its fair market value, it just kept growing. And by the time he wanted to sell the property, the number was greater than what he could sell it for. And that really impacted on his ability to sell the property. He couldn't, he had it on, like I say, for several months, if not several years. And just after I was able to reduce the assessment, he was able to effectuate the sale of the property at $3.8 million. So theoretically, the property is underassessed now. That's just one example. I'm really done with my presentation. That didn't take long. That's 11:30, a half hour. I just put my information up here. Most tax reps fees are contingency based, so there's nothing to lose. If I don't think I can help you save on taxes, it costs you nothing. And always you can give me a call for free market analysis. So this is just one of my broker friends who gave me a nice little recommendation here. I'm knowledgeable, very professional, knows her market. You'll never find anyone like her. She understands the nuances and shades of the market and the subtleties of properties. You'll be lucky to have her on your side. I'm passionate, I'm dedicated, I'm professional. I'll try to help you any way I can. And as brokers, always feel free to give me a call. I'm happy to help. I'll take any questions anybody may have.
Yeah, cool. Thank you, Nanette. Yeah, we have some time. If anybody on the call has any questions, feel free. I know that I have one that just a small little detail that I've always seen. I know some towns, when you see their assessment value on the MLS, some of them are at 100% value. Like the house is listed at 500,000 and the assessment is relatively close to that. But some towns have a much smaller assessment value. Is there any reasoning to that, where like you see the assessment and it says like $8,000 and you're like, obviously the house is not worth $8,000.
Right.
What's the point to that?
Well, that's indicative of a municipality that hasn't revaled in a long time. That's telling you that that assessment was set, I don't know, 40, 50 years ago. I mean, I don't know exactly, but that's an extreme, but that's probably how that happens. And then over time, because they don't maintain their assessments, the state issues those equalization rates. So that really low number has to be converted by an RAR as an indication of fair market value. So it doesn't impact on you. It may not, it looks odd, but know that once you see that really low number, that you have to do that math to get to fair market value or indicated fair market value of that assessment. Makes sense?
Yeah. What would you say is the success rate of when someone tries to get their taxes grieved, doesn't happen, and they go into one of the options that they have, like the SCAR that you mentioned? What's the likelihood of that appeal getting? Okay,
well, that's a good question. I will tell you, prior to 2021, the chances were very good. You probably had a 90% chance of success in a grievance proceeding. In 2021, it got even harder because the market, just kept escalating, which meant that the assessor not only had a lot of comps to choose from, there were people paying prices greater than what the properties were listed for. And that really drove the whole, it shifted the whole process in a different direction, in my opinion. And I've experienced, it's really difficult to challenge an assessment these days and to succeed. And it's dependent on the assessor that you're dealing with as well. I'm just going to be honest with you. The assessors that are at full value, Ossining, North Salem, Greenberg, Town of Rye, Town of Mamaroneck, Village of Bronxville, the Town of Pelham, they're doing a good job of maintaining their values. And so if that doesn't mean they're all accurate, that's really a misnomer. It just means they're closer to where they should be. And so your ability to challenge it and to, succeed is not that great, because there's a lot of data out there that you could pick and choose, by the way, and that's how it's done. They pick and choose the ones that's going to show, their ability to sustain an assessment. So I'd say you probably only got a 50-50 chance these days going forward, just again, my opinion. And until that market turns around again, even though it might be turning around a little bit, it's still pretty robust and still very, unpredictable, and still many properties selling at and above asking. And the marketing times and the low inventory, that all goes into this equation as well.
Yeah. Okay. I have a couple questions in the chat. The first one is, does a flood insurance requirement have any direct impact on taxes?
Okay, in a reval town, the municipalities are supposed to know which properties are in flood zones, and they will designate each property that's in a flood zone with a code. It's called an influence code, and it's supposed to go into that algorithm or that mathematical equation and serve as a negative to the value of the property, right? A property in a flood zone is considered a negative. They don't always capture them for whatever reason, that's a different story. Big municipalities have a hard time getting all of that data into their computers. And I think they're doing a very good job, but they may miss some. In the municipalities that are not revaluation towns, they don't have that information in their computers, or they may have sporadic information in their computers. So it would behoove the property owner to, make sure they understand that their property, if they're in a flood zone, has been valued accordingly. So the fact that there's a requirement for flood zone or flood insurance isn't a direct, doesn't directly impact on the assessment of property, but it should, and it does in the real world. And so if your value of your property does not reflect the flood zone, and it is in a flood zone, you need to evaluate whether the current assessment is accurate or not.
Okay. Cool. I think that answered the question.
I answered that.
But I definitely think it answered it. The next one says, let's see, did neighbors' taxes being much lower than yours have any impact on a successful grievance?
Okay, great question. Not really. The answer is actually probably no. And the theory is the laws require a municipality to assess at an average or a weighted average or a median of all properties in the municipality. That equality concept is what they call rough equality. If you're roughly or generally assessed properly, that's all the standard requires. And in order to prove an unequal assessment, I haven't seen anybody succeed, at least not in the last, 20, 25 years, because it allows the person making that claim to cherry pick those properties and those assessments that validate their claim without taking into consideration the other properties that are overassessed. So it's a very weighty burden of proof that a property owner has to succeed on a challenge of unequal assessment. And like I say, I've never seen anybody do it. If, they'll say, well, my neighbor next door has a better house, it's in better condition, they've got a swimming pool and I don't, well, my assessment's higher. It's a bitter pill for property owners to swallow, but you have to look at the land size, you have to look at the shape of the parcel, you have to look at the road frontage. There are a lot of variables and characteristics of a property that go into the assessment process. And while on its face it may look unequal, and like I say, unless it's really divergent, which it will be difficult to explain. You're almost impossible to make a successful grievance challenge based on an unequal assessment.
Thanks. Next question says, how about temporary reductions for distressed properties?
Well, there is no such thing as a temporary reduction that I'm aware of. You might get a one-time reduction, and then once you improve that property, your assessment's going to go up. But a distressed property these days would be, maybe one that had a oil spill or is located adjacent to a property that had an oil spill. What other kind of distressed properties can there be? There were illegal dumping on a site. There might be a couple other, they're not coming to mind right now, but That's a difficult concept in a strong market. What's a distressed property? One that's not selling, or one that's not selling for an amount that somebody thought it should list for? Or are you talking about some characteristics of the property itself that are causing it not to sell? So I would say there is no such thing as a temporary assessment reduction. And but if somebody wants to give me a call afterward or send me an email, I'm happy to expound on that.
Cool. You see what is the difference between property tax and assessment? Super simple question.
Yeah, I tried to capture that at the beginning, and it's because it is a hard concept, believe it or not, that people sometimes don't understand. An assessment is the value on which your property taxes are based. Now, if you got $1 million house, you're gonna have a $1 million assessment, and the taxes that you pay on that $1 million property are a function of the tax rate, and that's the amount of money that a municipality has to raise to pay their bills. To pay their staff, to pave the roads, to plow the roads, to provide building department services, zoning, planning services, et cetera. All government functions are paid for by taxation. And the amount of money to be raised is based on the value of your property. I hope I answered that properly.
Thanks. I have one other question. I know a lot of my clients are asking me if prices that have been rising for the past 2 years, if that is going to directly increase everybody's taxes in the areas of where prices are going up, because I think a lot of houses are selling above where they're assessed at in this market. So does that mean that towns that do reassessments every year, like Ossining, are their taxes going to be skyrocketing with all of these increased values, or are they adjusting their tax rate, or what's happening with that?
Okay, great question. I get that question, 4 or 5 times a week. I'll serve as consultant to some of the brokerage community. That's the number one question that I get, because people are afraid, that, like I say, the market is so strong that it's not keeping in pace with the assessed values. And so, like Ossining, just as an example, because you brought it up, they're at 100% of value. They were at 100% in 2021, and they are at 100% in 2022 as well. So that means your assessment is what your assessment is. It doesn't matter what it sells for. They've put that number on the assessment roll at 100%. That's their opinion of the value of the property, and your taxes will be based on that value. So it's again a mixing up of the assessment and tax concepts. Your assessment stays fixed. Will your taxes go up? They may go up, but that's a function of spending. And I will just say, I've seen some of the tax rates actually go down slightly, not a lot, slightly, because there's more mortgage recording tax going into the municipalities. There's more building department fees being paid that's going into the municipalities. They lost a lot of the recreation fees that they would have charged because they weren't able to provide recreation services during COVID. But that's a small percentage of their annual budget. But there are different ways that municipalities have income coming into them. One is the real property tax. That's the biggest one. So again, the values are staying the same because the market is so robust. Your taxes are not likely to increase. But the concern is when there's a big differential between what it's assessed for and what it sells for. What happens to that differential? And I've seen some $1 million gaps. I'm not going to, I've seen some 200,000, I've seen some 500,000 gaps. And in a municipality that revals, can't change that number to the new purchase price. But that sale of that property will go into the equation, that algorithm that they will use to update their assessments going forward. And all municipalities have the right to choose a revaluation schedule, and they have to put it in writing, and they have to file it with the Office of Real Property Tax Services. And they'll say, we're going to do it every 4 years, or we're going to do it every other year. I'll just give you an example in Greenberg. They do what they call neighborhood analyses, and they may even do that in Ossining, although I'm not certain what they do in Ossining. They will take all of the sales in a given neighborhood, and they will analyze it. They'll take that ratio of purchase price to assessed value, and they'll create a ratio, and they'll see what the ratio is, how far it is below 100%. And if it's significantly below 100% in a given neighborhood, they may use a trend factor to trend assessments just in that neighborhood. They're not required by law to do it to all properties in the municipality, because that's the benefit of creating neighborhoods, that they can analyze properties on neighborhoods. And we know that location is a driving force in the value of properties. So each neighborhood will be analyzed separately and distinct. And some may find their assessment's going to increase 5%. Some may find it's going to increase 3% or none. Again, they're not required to do it each and every year or uniformly across the board for every neighborhood, but that is a process that can take place. So and because the municipalities don't really want to put the word out there as to when they're going to update, because that does fuel a lot of fear and trepidation for buyers, you'd have to call there and see if you can get them to tell you, when they're going to do another update. And they'll probably hedge that answer. They'll say, well, maybe next year or maybe the year after, but your purchase price cannot be used to set an assessment. It can go into the equation, and there's supposed to be more than one sale that goes into that algorithm to determine your assessment. And so I've never seen where a purchase price becomes the assessment. The only time that happens is when the property is overvalued and the assessment has to come down. It'll come down to the purchase price, but it's not going to come up to a purchase price. I hope that's helpful.
Yeah, that's great. I see another question from Nan, which is another good one I think we all wonder about. Do all municipalities reassess when you pull or close a building permit? I know that when people do renovations, they worry about getting reassessed, especially when they haven't been.
Very good question. Yeah, that's something else brokers will want to know about. The answer is yes. Again, because of these new resources that assessors have, and because they have staff that can cull through the various listings in a municipality, if a property owner takes out a building permit close to the date of sale or the closing, how do I want to say, not necessarily the title pass, but even the contract signing date, and that goes into MLS, and the assessor sees that. And then they'll match the inventory that they see in MLS against the inventory that they have in their own records, their building department records, because they're turned over to assessors. They will match them to see if that improvement has been already captured in the assessment. And if it hasn't, they have the legal authority to increase an assessment, but only to the extent of the value of that improvement. And let's just use a kitchen because that's the best example or the easiest to explain here today. Kitchens can range from value, let's just say $100,000 kitchen. They can only add $100,000 of value to the base assessment. So $1 million assessment will become 1.1. And that's assuming that 1.1 doesn't exceed what the property owner paid for the property. So yes, they can do that. They do it. I don't know anybody that doesn't do it. But the one other part of that that's equally as important, and it really burns the buyers, is when property owners do improvements at their property and they don't take out building permits. Just because there's no mechanism for a municipality to check on that if somebody's going to do it without a permit. So they would. The assessor will look at all the sales in a municipality on MLS, and they'll see a brand new kitchen. And they'll match it against their building department records, and they'll show there was never a kitchen renovation. It goes back to the 1980s. And if you look at that photo, you can see that it's not a 1980s kitchen. They have the right, they have the legal authority to increase that assessment for that kitchen. And guess who gets, that falls on the buyer. The buyer will get a letter maybe 6 months after they purchase. The assessor wants to come in to look at the kitchen, and they're like, oh my God, you mean I'm going to get an assessment increase? I didn't know that. And, that's unfortunate. That's the process. It's sort of unfair, although it's not really buyer beware. It's supposed to be part of the due diligence that all buyers and perhaps all brokers are supposed to do when you present a buyer to a property. You really should try to have that information. You've already researched that information. And if like time doesn't permit, because we know that people are buying these properties sight unseen, and there's no such thing as going to the building department and being able to figure out whether there's a permit on that kitchen or not. There's time just doesn't permit it. But under more, under general better circumstances, or the way we used to operate, I should say, or when the market slows down, it really will protect the buyer's agent, that you've informed your buyer that there were no permits for this kitchen. There's the possibility that an increase, you might find an assessment increase after the sale. And again, every broker has to figure out how to handle that themselves. I'm just saying, from my perspective, and from an assessment perspective, even, if I wear my assessor's hat, that protects you. And that way there are no surprises. There are people that get surprises 6 months later and they're flabbergasted and they're angry at their buyer's broker because they had no idea that there was no permit on this kitchen. That happens. It happens a lot.
Is the risk relatively the same, whether it's a permit for just like a deck versus like putting a whole addition on a house?
Well, I would say in this day and age, there are probably not people making additions to houses and getting away with it without a building permit.
That's a great point.
I just think, maybe like a little bump out, and it's in the back of the house, and you're able to put the dumpster in the back of the house, and you live in a rural area so that people don't drive by, and the building inspector, lives, 10 miles away because there's, it's a really rural area, and you don't have too many neighbors, so they don't know what's going on. And they won't call town hall and say, hey, you better get the building inspector over there. And that happens a lot, by the way. People don't underestimate that. Your neighbors will turn you in. I used to get calls as an assessor quite frequently. One guy was playing poker in his friend's basement, which was finished, that had a kitchen, and he wanted me to know about that. That was like, I rolled my eyes, and I couldn't really take action on it because I'd have to have some basis for going there and knocking on their door. And I couldn't just increase the assessment because somebody told me that they had a finished basement. I had no evidence other than his word. But you'd be surprised, your neighbors will, even nice neighbors that you have a good relationship with, they want fair taxation, and they think that's the right thing to do.
Yeah.
I have a question for Nanette.
Hi,
Nanette,
Jen.
have you ever seen a situation where the assessment went up based on the list price of a home, not sale price? The home went on the market, was dramatically different than its assessed value, and the new taxes came out for the next year, still the house on the market, not sold, and the taxes went up significantly for that particular. Have you ever seen
Janet,
that?
I would say no. That would be what they call welcome stranger. That's a term that's popular in this world. That's illegal. There's case law on it. That assessment should be challenged, or should have been challenged, and an assessor will lose that. The only thing I can think of is that what caused that assessment to go up, again, was some physical change in the property that was not captured in the prior assessment. And you're entitled, or the assessor is obligated by law to explain that. Why did you increase my assessment? And so even if it paralleled, or even if it, was brought up to the list price, that may be coincidental. If that differential reflected the value of some improvements that were made at the property. But somebody should investigate that, as a general statement. That's against the law. It's called welcome stranger, and that should be challenged, and the assessor would be obligated to reduce it. And if they don't, you'd challenge that again, and you'd have to file a lawsuit. It'd be, a long, arduous process and costly, but it's not right, and people need to know their rights.
I appreciate that. It's a former client of mine from several years ago, and they did challenge it, and they went and met with the assessor directly to talk about it, and the taxes were brought back down, interestingly
Good.
enough.
Good,
So
good.
they were taken care of, but it was quite shocking to have that
and
happen.
it's and it causes a lot of anxiety for property owners, because they're not, they can't be guaranteed what the result might be, and it can have a great impact on their ability to afford their property. Their taxes could increase tremendously as a result of that.
Right.
And I never liked it when colleagues did stuff like that. But like I say, I would hope they would have some justification for it, not just that it's a new list price.
Mhm. Thank you for that.
Okay.
I have a question.
Hi.
How does an assessor determine the value of any sort of renovation? So like, do they just go on what was submitted with the building permit application, or do they eyeball something and say, well, this is 10 linear feet of white countertop and gray, gray cabinets, so this is per
Well,
linear foot?
that's another great question. It's an inexact science. And I can just tell you from my own experience how I used to do it. There are a lot of variables. It depends on the price range of house you're in, right? A $2 million house does a new kitchen. It's going to cost vastly different than a new kitchen in a $600,000 house. It's going to depend on the current assessment. If the property is already close to where it should be in terms of fair market value, and they add this new kitchen or they improve this kitchen, and they spend $50,000, depending on current market conditions, if I think they could, in the subsequent year, sell that property for $650,000, then I might assess it at $50,000, that new kitchen. But what a lot of assessors are doing are using prices per square foot. And we know that construction costs have gone up tremendously over the last 2 years. So prices per square foot have changed dramatically. I'd never liked to use a price per square foot. That's just based on my appraisal background, because prices per square foot are unadjusted. It doesn't tell you what price point of or quality of kitchen you put in. Did you put in, recessed doors, and did you put in the fancy countertops, and, you got fancy ceiling with the cutouts and the fancy lights, and, all of that goes into the equation. Or is it just really just new cabinets, maybe stock cabinets that you got at even Home Depot or at some vendor, but they're stock. There's nothing fancy about them. They're nice, they're new, but they're not fancy. That quality of kitchen is different as well. So prices per square foot are unadjusted. It doesn't adjust for location, doesn't adjust for quality, doesn't adjust for anything really. So that's how assessors do it. It's really an estimate. That's the best way to describe it. And it's based on their own personal experience and their knowledge of construction costs in the marketplace. And I always liked to not go on the low side. I don't mean, a different range, but if I thought a kitchen would have cost in all complete, depending on the dimensions, a small kitchen cost $50,000. We know you can spend $50,000 easily on a brand new kitchen to make it nice. And I'm not talking about a fancy kitchen either. I might put that at 40,000 increase. If I thought it cost 100,000, I might put it at 85,000. Because, the theory is in a prior market, you didn't get a dollar for dollar return on that expenditure. Even if you put in $100,000 kitchen, can you say that you're going to get $100,000 back in value? Not immediately, maybe long-term, maybe not, because once it depreciates. So there's always that, I use the concept something less than dollar for dollar, but not all assessors. And in this market, most assessors are getting dollar for dollar because they're emboldened by the strong market in which we're working. There's just too much data out there that supports their numbers.
Can a homeowner appeal that number? So like if they actually spent less than whatever the new assessed, that like the increased assessed value is, can they say, hey, I spent less than that, here are my papers, or I did the work myself, so that's 50,000 off on the labor? I mean, can they say that? Or
yes and no, they can say that. Again, anybody can grieve an assessment. It goes in front of the board of review. Your ability to succeed is based on the veracity of the evidence that you submit. Homeowners do not get the benefit of doing it themselves, and this is the reason why. I'm not a contractor. Maybe you're not a contractor. I could paint, maybe that would be it. So there has to be a common denominator that is applied to all properties. And the common denominator is fair market value. It assumes that you're going to get a contractor, and that contractor is going to install that kitchen from top to bottom, and that the property owner doesn't get any benefit of that. Your taxes can't be lower just because you're a contractor and you did that kitchen renovation. It's the value of the property when it's complete. How much value did it add to the property? So again, yes, you can protest it. And the only thing with homeowner records, and I always had a problem with that, but now I'll give people advice and I'll say, make sure they keep good records. have them put together an Excel spreadsheet and make sure they attach all of those receipts at the back. And if they have an AIA contract, attach that contract, and that contract will itemize what items aren't included in that contract. It'll say the cabinetry is not included, the tile and the countertops are not included, the flooring's not included, but the installation will be included. So if you have good evidence and it looks all complete, and when the homeowner controls the evidence, the assessors always speculate that you haven't submitted everything or every cost that you've expended. So it leaves a doubt in their mind, or even in the mind of the Board of Assessment Review, that you've, submitted everything that you should have submitted. So I would say, yes, you can always challenge, but it goes to the veracity of the evidence that you submit. It's going to be hard, though. I don't want to mislead you. It's going to be hard to win a case on that. Okay.
Cool. All right, well, we're at 12 on the dot. I don't see any
No.
more questions in the chat. So your contact information was on one of these slides, and we will
Yep,
send out.
sorry, I should have put it here. I put it
Oh,
on
you're good.
others. Yeah, and I
Um,
just want to invite anybody. I do take phone calls all day long from brokers asking questions. And if I can ever offer my advice or assistance to anybody, please feel free to give me a call.
Cool, thanks. And we'll send out a copy of this slideshow to anybody that wants a copy as well. Other than that, thank you, Nanette, and thank you everybody for coming out to join us.
Yes, thank you, everybody. Thank you, Tony. Thank you, H.
Yeah.
Anna. I appreciate it.
All right, thanks everyone. You have a great day.
Thank you. Have a good day.
Bye.
Bye.